Hello and welcome to another episode of Full Court Finance here at Zacks. Today we are once again going to break down some stocks that investors might want to consider buying for now and for the long term for their ability to grow and withstand economic downturns. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. Alrighty, so the Dow, the S&P 500, and the NASDAQ all slipped through early morning trading on Monday. This comes as the start of Q1 earnings season unofficially kicks off this week, so investors in Wall Street will be watching JP Morgan Chase, Bank of America, and some other big banks, as well as health insurance giant United Health and transportation bellwether J.B. Hunt Transport Services. So all of these firms could help start to paint a better picture of what the economy looks like in their second quarter guidance. If they provide any, will likely be even more important, because at this point, the uncertainty is maybe as high as most people thought it could ever be, because there's really just no sense of when we're going to return anywhere near quote unquote normal, even though there are signs that social distancing measures are working. And so far, just for reference, as I mentioned, that we're unsure if companies will even provide second quarter guidance. 300 companies have withdrawn their financial guidance, and this is according to the Wall Street Journal so far. And the U.S. economy has come really as near to a halt in many sectors as many thought possible. A record 17 million people have filed for unemployment benefits as the lockdown has spurred a wave of layoffs and furloughs. That said, the market has rallied big time since its March 23 lows. The S&P 500 climbed 12% last week alone for its best weekly performance since 1974. And this is part of a larger 25% rally over the last 3 weeks, which does show why investors should most likely never pull out of the market altogether, because when you pull out, you likely miss these big bounces. That said, the index is still down 14% for the year, and volatility could remain due to, as we mentioned, just the complete uncertainty at this point. So I'm not going to dive into more details about what people expect, because at this point, no one really knows and everything's changing on a daily basis. So we're going to go right into some 3 highly ranked stocks that investors might want to think about buying right now. And we're going to start with the Clorox company. They trade under the ticker CLX. And as most of you probably know, they sell disinfectant products that kill germs at home and in a healthcare setting, which makes it almost tailor-made for the current coronavirus economy. The CLX stock has also climbed in 2020 as the broader market tumbled. And better still, Clorox's portfolio is way more diverse than some people might think, and it appears to be a solid longer-term buy. So we're going to dive a little bit into what they do and then some more of their fundamentals before we wrap up on Clorox. So Clorox's portfolio includes its namesake disinfectant wipes and other offerings geared toward household cleaning. The company also boasts products made specifically for the healthcare industry, which includes Clorox Healthcare Bleach. So very specific, a product that's probably in heavy use at the moment. They've had recent blog posts even before the coronavirus outbreak started that the company aims to help in the battle against superbugs, and it now tests its disinfectants to the highest standards. And then on top of that, Clorox also has different products. Sorry, I had scrolled down farther in my notes. The firm's portfolio includes everything else, such as Kingsford charcoal, Brita water filters, Hidden Valley Ranch, Burt's Bees lip balm, and way more. And then overall, 80% of their sales are what they call generated from the brand that holds the number 1 or number 2 market share position in their category. So that's Kingsford and Brita and Clorox. So their brands obviously have competitors, but they either hold the number 1 or 2 market share in that category for 80% of their sales. And then overall, Clorox operates what I guess you could call pretty recession-proof style portfolio. Cleaning products make up about 35% of its sales. Its household unit, which includes trash bags, cat litter, and more, accounts for about 30%. And then its lifestyle and international segments make up about 20% and 16% respectively. So we're going to jump into some fundamentals. Clorox shares have outpaced their peers over the last 5 years, up about 66% against its industry's 33% average climb. Clorox stock is also up about 20% so far in 2020, and this comes against its industries and the S&P 500's 14% downturn. So it's been able to succeed in 2020 while most companies have fallen down. That said, its valuation picture is a little stretched at the moment, but it still rests below its 12-month highs, and it's trading close to its 5-year median in terms of forward 12-month Zacks earnings estimates. And despite the climb, its dividend yield comes in at about 2.3% right now. This helps top the 10-year U.S. Treasury notes, 0.72%, as well as the S&P 500's average. So you're getting a solid dividend yield as well. And then if we look back, the company topped our Q2 fiscal 2020 earnings and revenue estimates in early February. And since then, its earnings revisions have climbed. This helps it earn a Zacks rank #1 strong buy at the moment, alongside a B grade for growth in our style score system. And in the end, it really seems that Clorox might be a stock worth considering amid the current economic climate and going forward, given its really expansive portfolio of household items and quintessential kind of consumer staples. So this could be a consumer staple stock with a diverse portfolio that investors might want to consider now and longer term down the road. And now we're going to move on to a company that's very different from Clorox, much smaller, much more recently public, and that is Sprout Social Inc. It trades under the ticker SPT. So simply put, Sprout's cloud software offerings allow customers to manage their social media efforts across a centralized platform. The Chicago-based firm enables businesses to bring together what they call social content and messaging, data and workflows in a unified system of record, intelligence, and action. SPT's business model looks pretty attractive as companies, organizations, schools, governments, and more attempt to maximize their social and digital efforts across a growing number of platforms. You really have to have a great reach online and on social media. And Sprout offers its platform for the largest of these companies. So that includes Facebook and Instagram, Twitter, Pinterest, LinkedIn, Google, and many more. The firm also boasts over 23,000 customers, and its fiscal 2019 revenue climbed 30%. And investors should also know that the company just went public back in mid-December of 2019. And the company really believes it's in a good position to grow long-term as part of what it refers to as a multi-billion-dollar market opportunity. And yeah, just as I mentioned, the whole social media and digital media world is exploding. And now there's more platforms than ever. So it's trying to give people a one centralized way to have a unified message and really interact well with their customers. With that said, SPT's shares have fallen off somewhat after getting off to a pretty hot start early on. So Sprout stock is trading at about $13 per share as of Monday morning, which puts it roughly 40% below its highs. So it's a quote unquote cheaper stock that investors might want to buy, and it's traded above $20 a share since going public in mid-December. So looking ahead, our Zacks estimates call for Sprout's fiscal 2020 revenue to jump another 26%, with 2021 set to climb another 30% higher. So some impressive growth for 3 years. And then meanwhile, its adjusted loss is expected to shrink substantially this year and next. And along with this, its longer-term positive earnings revision activity helps it earn a Zacks rank #1 strong buy at the moment. It's also part of a highly ranked Zacks industry, and it seems like it should be able to exceed during the coronavirus economy and beyond. But with that said, it's certainly a stock that's more risky, just in the sense that it's newly public, it's trading at under $15 a share. So it would be widely considered a cheaper stock. So only more risk, uh, people who can deal with the risk should think about buying Sprout at the moment, given the current volatile market conditions. But with that said, we won't really have to wait that much longer because the company is expected to announce its next quarterly results on Wednesday, May 6th. So pay attention to that for anyone who's thinking about buying Sprouts. You might want to wait, or you could think about scooping up some shares at the moment. And then we're going to close with a company that most people know, and it's certainly one that's gotten a lot of press during the coronavirus, and that is Netflix. So Netflix stock is up 22% in 2020, and it's climbed another 6% as of Monday morning. So the question is, should investors think about buying NFLX stock? So that's Netflix ticker, with it set to report its Q1 results on April 21st. So I believe that's next Tuesday. So next Tuesday, they're set to help kick off a wave of those big tech companies. All right. I mean, most people understand the pitch for Netflix, but I'm going to dive into it. So many Americans and people around the world have been stuck in their homes for weeks in an attempt to try to flatten the coronavirus curve. And there have been signs, as we know, that the social distancing is working. But with that said, it's unclear really when things are going to start to return to normal, as we mentioned at the top. So even after things, or when things slowly return to normal, we might not see people going to movie theaters or going to sporting events, and instead they're likely more often going to spend that time at home, maybe watching a movie instead of watching sports. And if sports don't return to television, especially in the summer, baseball's a highly watched sport in the summer when there's not much else on TV. You could see more and more people turning to streaming TV as well. And currently, Netflix is the world's largest streaming TV company, so this really puts it in an ideal spot. Netflix boasts about 167 million global users, and it beat its own Q4 fiscal 2019 subscriber estimates. And obviously, it faces competition, and this has worried some investors in Wall Street. So that includes giants like Disney and Apple and Amazon and HBO Max. But just because there's competition doesn't mean it's necessarily going to hurt Netflix. It can be kind of a rising tide, lift all boats situation, because the cord cutting revolution is really just starting. So overall, eMarketer expects that roughly 56 million households will have canceled their cable or satellite TV subscriptions by 2023. And most of those people are likely to have then multiple different streaming TV subscriptions. So just because you sign up for Disney Plus, which is actually way cheaper than Netflix, the offerings on Netflix versus Disney Plus are very different as well. So it's not like a Spotify versus Apple Music situation. There's completely different content across all of these various streaming TV offerings. So now we're going to go ahead and look at some more fundamentals for Netflix. So Netflix shares have surged over 40% since late September. And as we mentioned, they're up about 20% in 2020. And it sits not too far off its 52-week highs at the moment. And with that said, the stock has been pretty volatile over the last several years after its insane run through much of the 2010s. So it's really slowed down over the last couple of years as well. So maybe Netflix could finally break out again and see it go on a big run. And obviously, as we mentioned, the company is pretty tailor-made to weather the current coronavirus economic downturn, and it's still trading at pretty high forward earnings multiples, but it's trading below Netflix, actually, or not. It's trading below Amazon in terms of forward 12-month Zacks earnings estimates. So it's trading at about 54.5 times forward earnings compared to Amazon at about 63. It's also below its own 3-year median of 86 times forward earnings. So its valuation has certainly come down in terms of its forward earnings multiple. And then one other note that has some investors a little more nervous is that the company has taken on a lot more long-term debt. It finished 2019 with about $14.8 billion in long-term debt, up from 10.3 at the end of 2018. And this is the company's going to continue to take on debt, and this is to fund its operations, specifically to make more and more movies and TV shows, which is really the lifeblood of their platform. I'm going to read a little note from their last press release. So along the way, they say, we will continue to use the debt market to finance our investment needs. Skip through then. So this is their free cash flow portfolio or profile improving. This means that over time, we will be less reliant on public markets, and we will be able to fund more of our investment needs organically through our growing operating profits. And this was from their Q4 earnings release. So with that said, the company expects to add about 7 million paid users in Q1. And this was before the global pandemic rolled out. So maybe they could add even more users. This would roughly mark about 17% expansion from the year ago. You can see it closed with about 174 million users. And then if we look at our Zacks estimates, we're calling for its adjusted Q1 earnings to skyrocket 112% to $1.61 per share. And then the company's first quarter revenues are expected to climb over 26% to about 5.7 billion. And this would also top Q1 of 2019's sales growth at 22%, which is always a good sign. So they've also had some positive earnings revision activity that helps it earn a Zacks rank number 2 buy at the moment. And the company has also crushed our bottom line estimates in 3 out of the last 4 periods. So once again, as a reminder, the company is set to report its Q1 results on April 21st. So some investors might want to take a chance on Netflix for the near term in the coronavirus economy and longer term as a bet on it returning to some growth and as a real leader in streaming TV for what could be years to come, despite the competition. But with that said, anyone who's thinking about buying Netflix before their earnings is taking a real chance that they will beat their user growth estimates, because the company pretty often trades based on if they beat or miss their own subscriber estimates. And as I said, they made their estimate before the coronavirus caused a bunch of people to have to stay at home for so far even a month, and it's going to be longer. So they could top that estimate, but really it's worth maybe holding off until after, but it's a bet on if they're going to top their subscriber estimates in the near term, most likely how they will trade. So overall, we looked at 3 pretty diverse companies that look solid both now during the coronavirus economy and longer term. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. Remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.